Welcome to our deep dive into the escalating US-China trade war, a clash between the world's two economic giants that's reshaping global markets. Tariffs are soaring. US duties on Chinese goods hit 145%, while China retaliates with 125% levies. This isn't just about trade. It's a battle for economic dominance, technology, and geopolitical leverage. Both nations are digging in, with the US aiming to curb China's trade practices and China vowing to stand firm. But who's really winning? In this video, we'll break down 10 key points, economic impacts, supply chain shifts, consumer effects, and more to see which side holds the edge. From rare earth mineral bans to tech exemptions, we'll unpack the latest moves and what they mean for the future. Stick around, hit that subscribe button, and let's dive into the data to uncover the real winner in this high-stakes showdown. Don't forget to like and share if you find this insightful. 1. Tariff escalation and economic impact. The trade war's core is tariffs. The US imposes 145% duties on Chinese goods, aiming to punish alleged unfair practices like subsidies and tech theft. China counters with 125% tariffs on US imports. The US imported $438.9 billion from China in 2024, far exceeding its $143.5 billion exports, giving China a trade surplus. High tariffs disrupt this, raising costs for US consumers and firms. China's economy, export-driven, faces pressure, but its authoritarian system absorbs hardship better. The US sees inflation risks, with Yale Budget Lab estimating 740,000 job losses by year-end. China's yuan hit a 17-year low, signaling strain. Yet, both sides show resilience. US firms seek alternatives, while China boosts domestic tech. Neither is collapsing, but the US's larger import reliance gives China slight leverage. Short-term, tariffs hurt both, but China's export dependence makes it more vulnerable if trade halts. 2. Rare earth minerals and supply chains. China's suspension of rare earth mineral exports is a bold move. These materials are critical for semiconductors, EVs, and defense tech. China dominates 60 to 70% of global supply, giving it a chokehold. The US, reliant on these imports, faces risks to industries like automaking and tech. China's ban aims to pressure the US, but it's a double-edged sword. China loses revenue from these exports. The US is diversifying, with projects in Australia and Canada, but scaling takes years. Meanwhile, China's push for self-reliance in chips and tech, AI initiative, strengthens its hand. The US exempted smartphones and chips from tariffs, signaling dependence. Medium-term, China's control over rare earths gives an edge, but long-term US diversification could shift the balance. For now, China's supply chain weapon is potent, forcing US firms into costly adjustments. 3. Consumer price impact in the US. US consumers face higher prices as 145% tariffs on Chinese goods ripple through. China supplies 15% of US imports, including electronics, apparel, and toys. Tariffs force firms like Nike, 95% of footwear from Asia, to raise prices or absorb losses. Inflation is a real threat. Analysts predict a 2 to 3% price hike on consumer goods. US firms can't quickly replace Chinese supply chains, as alternatives like Vietnam often use Chinese parts. Lower-income households, reliant on cheap imports, are hit hardest. China's retaliatory tariffs don't directly affect its consumers as much, since US goods are a smaller share of its market. However, China's export slowdown could curb domestic growth, indirectly affecting its middle class. The US consumer bears the brunt now, giving China a slight advantage, but sustained inflation could spark US political backlash, complicating Trump's strategy. 4. China's retaliatory measures. China's 125% tariffs on US goods target agriculture, autos, and tech, hitting US exports like soybeans, $14 billion annually. It also suspended Boeing jet deliveries and banned US tech purchases for state agencies. These moves hurt US firms, Boeing stock dipped 5% after the ban. China's unreliable entities list now includes Raytheon and Lockheed Martin, blocking their access. Beijing's rhetoric, invoking Mao Zedong, signals defiance. China's preparing for a long fight, with policies like Innovation and Technology Advancement Initiative to reduce reliance on U.S. tech. However, its measures are less disruptive than U.S. tariffs, as U.S. exports to China are smaller, $143.50 billions versus $438.90 billions imports. China's economy can't fully decouple, but its targeted retaliation shows strategic focus. For now, China's countermeasures are effective, but limited by its smaller export leverage, making this point a draw. 5. U.S. tech exemptions and vulnerabilities. The U.S. exempted smartphones, semiconductors, and solar panels from 145% tariffs, revealing its reliance on Chinese tech supply chains. Companies like Apple and Nvidia benefit, as 90% of U.S. smartphones come from China. This move keeps consumer prices stable, but undermines Trump's decoupling rhetoric. China's control over these supply chains gives it leverage. Any disruption could spike U.S. tech prices. Meanwhile, China's IEAI initiative pushes domestic chip production, reducing its U.S. reliance. The U.S. is investing in domestic semiconductors via the CHIPS Act, but it's years from self-sufficiency. China's ability to withhold critical components gives it a short-term edge, while the U.S. exemption buys time but highlights weakness. Long-term, the U.S. could close the gap, but for 2025, China holds the upper hand in tech supply chains. 6. Political will and public support. China's authoritarian system gives it an edge in enduring economic pain. Xi Jinping faces no elections, and state media frames the trade war as a patriotic fight, rallying citizens. The U.S., however, is politically divided. Trump's tariffs aim to revive industry, but rising prices risk voter backlash. Polls show 60% of Americans support tariffs, but only if prices stay low. China's government can subsidize firms and control dissent, while U.S. firms lobby against tariffs, citing job losses. China's invocation of Mao and fight to the end rhetoric shows resolve, but its yuan's 17-year low signals economic strain. The U.S.'s democratic checks limit Trump's escalation. China's political cohesion gives it a short-term advantage, but long-term U.S. public support could shift if economic pain grows. For now, China's unified front is stronger. 7. Global market reactions. Global markets are volatile as the trade war escalates. Japan's Nikkei fell 3%, and gold futures hit $3,177.50, a 4.7% weekly gain, signaling fear. The U.S. dollar weakened, while China's yuan hit a 17-year low, raising concerns about financial instability. China's central bank vows a moderately loose policy to stabilize markets, but analysts doubt a sharp yuan devaluation due to risks. U.S. firms like Apple saw stock dips before exemptions eased losses. China's export markets, like Southeast Asia, are hedging, with Xi's regional tour securing ties. The U.S.'s tariff pause on allies like Canada shows a broader strategy, but alienating partners risks isolation. Both economies drive global growth, so disruption hurts everyone. China's market resilience and regional diplomacy give it a slight edge, but global uncertainty benefits neither. 8. Negotiation dynamics. Neither side wants to blink. Trump awaits Xi's call, but China's defiance, evoking Mao, shows it won't yield easily. China appointed Li Changgang, a WTO veteran, as trade negotiator, signaling a legalistic approach. The U.S. insists China must move first, citing its trade deficit. Past talks, like the 2020 Phase 1 deal, paused escalation but didn't resolve core issues. China's Commerce Ministry says talks need mutual respect, but Trump's 145% tariffs signal distrust. China's regional trade pacts, like Regional Comprehensive Economic Partnership, diversify its options, while the U.S. relies on domestic strength. Analysts see escalation before de-escalation, as both prioritize saving face. China's strategic patience and new negotiator give it a slight edge, but the U.S.'s economic clout keeps it competitive. For now, the standoff persists with no clear winner. 9. Long-term strategic goals. The U.S. wants to curb China's tech rise and trade practices, aiming for economic decoupling. The CHIPS Act and rare earth diversification are steps towards self-reliance. China's IDAI and domestic tech push aim to end U.S. dependence, with $1 trillions invested in chips since 2018. The U.S. seeks global tech dominance, banning Chinese firms like Huawei from key markets. China prioritizes stability and regional influence, securing ASEAN trade ties. The U.S.'s trade deficit gives China leverage, but its authoritarian system risks isolation if allies align with the U.S. Long-term, the U.S.'s innovation edge could prevail, but China's scale and speed are formidable. In 2025, China's cohesive strategy and supply chain control give it a slight lead, but the U.S.'s global alliances keep it close. This point is a draw, with both playing the long game. 10. Geopolitical ripple effects. The trade war spills into geopolitics. China's rare earth ban and Boeing suspension signal its weaponizing trade. The U.S. counters with moves like banning federal employees in China from romantic ties with Chinese citizens, citing security. China's Global Times calls U.S. actions bullying, while the U.S. eyes Panama Canal and Greenland to curb China's influence. Taiwan tensions loom. China's military drills signal readiness, while U.S. shipbuilding lags. China's yuan weakening aids exports but risks capital flight. The U.S.'s tariff pause on allies like Mexico aims to isolate China, but risks backfiring if allies resent Trump's tactics. Both nations lose if global trade collapses, but China's regional diplomacy and resource control give it a slight edge. The U.S.'s military and tech alliances keep it competitive, making this a close call. That's our breakdown of the U.S.-China trade war in 2025. 10 points showing a complex, high-stakes battle. China holds edges in supply chains, political cohesion, and regional ties, but the U.S.'s consumer market, tech exemptions, and global alliances keep it in the fight. Neither is winning decisively. Both face economic pain, with global markets reeling. China's strategic patience and resource control give it a slight lead, but U.S. innovation and political pressure could shift the tide. What's next? Will tariffs climb higher, or will talks break the impasse? Let us know your thoughts in the comments. If you found this analysis eye-opening, smash that like button, subscribe, and hit the bell for more deep dives into global trends. Share this video to spark discussion, and check our channel for updates on this evolving story. Thanks for watching, and we'll see you in the next one. Stay curious and keep questioning the world around you.